Hi everyone and welcome to Boothy's Bites. Boothy, welcome to your own show. How are you?
Yes, hello Jackie, how you doing? All right?
Pretty good, thank you. You well?
I am, yeah, it's good. It's a Monday morning and I've had a great few days of sailing around Port Stephens, which I told you about. So I've come back probably a little bit sunburned, windburn, and a greyer, longer beard than I should have, but very enthusiastic to get back into work.
Good, that's all we need. All right, let's get right into it. So, what's your read on what's happening in the markets right now?
Yeah, so we've had a pretty crazy couple of months, haven't we, really? So, I mean, we really didn't expect this conflict in Iran with Israel and the US. And obviously the impact of that has been that oil side of things, which has put some heavy brakes on our economic momentum, which is a bit tough, really, because we had these, the last 18 months where we've been trying to cool inflation. The RBA felt they'd got on top of everything, and it's made it a bit of a problem for the market. So it's a big shame. So sadly we're back to trying to beat inflation. We really don't know what that inflation number looks like because this rolling sort of flow on effect of the higher fuel prices will have cascading cost increases to many of the CPI goods which are valued. Really, the RBA has no control on it bar the interest rates. We don't know what the timeline, for the Middle East is really now. I mean, it seems like it's changing daily. So, the government's got to manage that. And, if we do become pretty short of fuel, that is definitely a worry. But, this means that we are looking at higher interest rates, sadly. So, the markets have already increased their sort of forecast for interest rates, and I think we're probably looking at certainly 0.25% in the next couple of months, if not 50 basis points over the next 3 to 5 months, I think, right now. So that's sort of where we're looking, which is a shame.
Yeah, so you've said no change for the RBA meeting in May. So what's behind that call?
I just feel if I was having to make these decisions, which I don't get the privilege of, I would want to sort of really digest exactly, what is happening in the world, what some of the negotiations are with regards peace and some stability in the Middle East, because all of this is, it's just really a lot of noise and a lot of volatility. I know it's war and that's a very terrible thing, but certainly, from an economic perspective, this is something which is, I'm hoping is short term and something which then can be, managed ongoing. So I just feel that the RBA should take the time to sort of consider what this oil impact is. I do believe, from a cash rate, it does have to go up just to accommodate some of the issues we're going to have with inflation. But really, it's sort of to increase by more than 25 points in the next sort of 3 months, I think is a little bit unreasonable. Certainly, I think they've got time to sort of wait and see. And the other thing is, my birthday's in June, so they can change it on that.
Oh, okay. There we go. You've heard it here, everyone. We have to get Boothy's birthday present organised.
And I always get it wrong, Jackie, right? So if I call it for June, they'll go in May. So, never back a winner. Or me.
Never back a winner. It's making sense. So where are rates sitting right now for both owner-occupiers and investors?
The lenders have passed on all of the RBA's hikes in the cash rate. So, I mean, that's a given. The really nice thing is that there's no sort of bracket creep from any of these lenders right now. The volume in the system has certainly declined a little bit, and there's not as many purchasers. The refinancing market has certainly slowed down a bit. So, the variable rates, I mean, our most competitive variable rates for owner-occupier down at that 5.6, 5.7%. Are the majors, they're price matching. So if you've got large loan, low loan to value ratio, they will price match. So do reach out there. The fixed rates, the competition there, MoveBank has got a 5.99 3-year fixed rate, which I think offers some considerable value for money right now, in line with these 2 interest rate hikes, if not more. And the investor market, some of our favorites there, People's Choice, so they're kind of outliers and really winning with rate. They're 5.79. That's for interest only and principal and interest. And then Bendigo Bank have got a 6.24 interest only fixed rate again. But I think, interesting, these interest rates, the fixed rates have really moved in line with the markets. we are starting to see some cashback offers now as well. So ANZ have come out and looking for a $2,000 retention, stay with ANZ. And similarly, some lenders are offering cashback offers to move as well now. So this will be an interesting time because we had this in the COVID time and it got a bit messy for everyone. But anyway, the cashbacks are back, which is I think is a bit of a negative thing. But anyway, we'll play the system, right?
Yeah, that's it. Now, what does a 0.5% rate increase actually mean for the average borrower right now?
Yes, that's a good question. So, if we're looking at sort of an average home loan rate, let's say $800,000, with that 0.5% is about $250 per month in extra repayments. Yeah. So that's going to hit the bottom line or the budget of the borrower. The other thing there as well, that cost of, fuel and household budgets is another $500 a month. So, those two things that combined number of about $500 a month does impact borrowing and affordability. Sort of for an average couple on decent income, probably decreases their borrowing capacity by about $100,000 now with a mainstream lender, and that's the reason is obviously living costs have gone up, so that's got to be disclosed. But the second thing is that interest rate assessment rate has also gone up by 0.5% now, so that's got an impact as well. But what I would say by that is it's worth doing a review right now because where the banks are for their affordability is quite different from some of the non-banks. So again, we do have the ability to potentially gear a little bit harder with some different lenders. So it's definitely well worth a review right now if you're looking at affordability to get in that next property.
Yeah, absolutely. And what are you seeing in the bridge and equity loan space right now?
We've seen a few different product providers come out recently. So we had a short-term lender on the Coffee Club last month. Similar this month, we've had Clinch, which is a new business which has come through to us. So our aggregator is basically accredited Clinch, which is a bridge and equity loan business. And basically they're there to help anyone who's either purchasing a property today and not sold their existing property, so gives clients time to own, clean up the primary place of residence, sell that, and then have no debt and move into the new place. That's bridge no end debt, and that product is very flexible. So there's no demonstrative affordability, good loan to value ratios, quite a simple, quick assessment. And that helps you sort of get through that period. The other one there, which is quite interesting, if clients are sort of going through a bit of an asset hold short term, can't demonstrate income, but just need to get by for the next few months, whether it's buying property, transferring ownership property, or even just some short term lending for personal purposes until they actually sell that property. Clinch also does an equity loan as well, which is pretty cool. So things like divorce, health problems, managing excessive hospital costs and things like that. The Clinch product there is there to borrow with a view of actually selling assets to clear off that debt for whatever reason. So again, it's a new one and it's a code product as well. So it's very interesting these products are coming into market.
Yeah, some great products there. And what are you seeing in the property market at the moment?
I suppose the appetite to purchase right now, if you say that, because of the increase in interest rates, I think a few people are reconsidering, cash flow budget may well get tighter. I know we've only had 0.5% now, but certainly if we go another 0.5%, that's going to have put a lot of pressure if people are looking to purchase an investment property in particular. So I think that will cool a little bit. That sort of appetite to heavily gear right now is a little bit less. So the property markets certainly have slowed down in the last couple of months. The auction rates have been a lot less in the main metros. The appetite to invest, in particular like Brisbane and your Perth markets, your Adelaide markets, that's certainly cooled down. So it's been pretty tough for the real estate agents right now. And the second part of that, the appetite to actually sell your home and upgrade your home has certainly gone. The cost of taking on a large mortgage and trying to get to the next property, that market for actually borrowing quite a large amount of money is harder to do these days. Then lastly, would you build in this market? Well, the cost to build has actually increased as well. So again, people are rethinking their budgets and their strategies around that. I suppose some positives in the negatives, as it were. There's a little bit more activity in Melbourne, so there's definitely some people, if they're still looking to purchase, the price point in Melbourne seems to be quite favourable right now. But I suppose the last thing we really should consider is, the current government is looking to have a budget. I think it's this month, and Jim Chalmers is calling out for some it's in May, considerable changes to the CGT and potentially negative gearing for property investors in particular. So, before you consider buying, you really want to know what we're up for, whether it's retrospective changes or future changes. We're not 100% sure right now, but if those changes, those changes are tabled for the next budget, and it does impact those people who are investing in property. So I would wait and see as well right now. So again, that's going to be a further dampener to people purchasing properties. So yeah, interesting times from a property point of view, yeah?
Yeah, definitely. And let's wrap up with a quick run around Lydian HQ. What's happening there?
Nothing major this month. It's been, I suppose, a bit of a quieter month. One positive we've had, which has been really great, is we now do have a specialist partner who can help and support our UK expats. So if you're living in Australia, you're living over here for the high life like myself, but are lucky enough to hold on to a property in the UK, and you have some debt on that, so it would be an investment property per se. We've got a partnership with a group called Capricorn Finance now, which is financial consultancy, and that group is one of the largest mortgage broking businesses in London, and they're able to help our UK expats as well. So that's really cool. So we've got a solution for those guys. Secondly, as well, we're looking after their Australians living in London or in the UK, and we're looking after their Australian properties as well. So that's a really nice partnership. The other thing that they do have as well is if you've got any high net wealth clients who are living in Asia or Southeast Asia mainly, we can actually support those clients as well now with some lending. So yeah, we've got a new partnership with an international flavour to it, which is pretty cool. And being a POM, I'm happy to support my fellow POMs moving to Australia, but keeping some of those investment properties in the UK, and we can provide debt solutions for them now as well. So yeah, welcome to Lydian UK desk.
Yeah, we've gone international. Woohoo!
I get a tax deduction on my next trip to London now. That's it.
Yeah. Well, Boothy, thank you so much for your time as always.
See you later. Have a great one. Ciao, ciao, Jackie.
Bye.
Bye.